Hi everybody, welcome back to our continuing series of study guide lectures for Chapter 21. In our last video lecture, we were able to calculate the cash received from customers and cash paid for inventory for Success Systems in getting ready to prepare Success's Statement of Cash Flows for the year ended December 31st, 20X2 under the direct method. These were rather complex calculations, and the reason is that we needed two T accounts to calculate the cash received from customers, and we needed two T accounts to calculate cash paid for merchandise inventory. Two T accounts were necessary because there were two accounts on the balance sheet that affected those numbers on the income statement. Revenue is affected by what flows through accounts receivable and what flows through unearned revenue. And cost of goods sold is affected by what flows through merchandise inventory, and given the facts and circumstances in this situation, what flows through accounts payable as well. Good news is that all the rest of these numbers have either only one balance sheet account or no balance sheet accounts at all. So they're going to be a little easier to calculate. So let's get started calculating the rest of the numbers we need for the statement of cash flows prepared under the direct method and shown as operating activities. The next thing we're asked to calculate is cash paid for wages. So we need to look at wages expense under the accrual basis as shown on the income statement and see if there was a prepaid wages or a wages payable account on the balance sheet. Accrual basis wage expense is $3,250. And we don't have any prepaid wages in the asset section, but we do have a wages payable in the liability section. So we're going to need one T account. Let's put our beginning and ending balances in our liability wages payable T account. Wages payable is a liability account, so their balances are credits. The beginning balance was a $500 credit balance, and the ending was an $875 credit balance. Now let's put in our accrual basis wage expense. Think about the underlying transactions. Throughout the year, whenever we recorded wage expense, we debited wage expense and credited wages payable. So we're going to put the accrual basis wage expense as a credit, which is this half of the journal entries, into the T account for wages payable. The accrual basis wage expense is $3,250. So multiple times throughout the year, we recorded wages with a debit to wage expense for a total of $3,250 throughout the year, and a credit to wages payable. That's what this credit is doing, sitting right here. Now, our T account is out of balance. $500 credit plus $3,250 credit minus something will equal $875 credit balance at the end of the year. To do the math on that, we can back into the number. 875 credit, subtract $500 credit, subtract 3,250 credit, and that leaves a negative 2875. This negative means it's the opposite of the credits, so we need to debit the account 2875. You can and you should check your math by working forward. Does 500 credit plus 3250 credit minus 2875 debit equal 875 credit balance? And the answer is yes, it does. So the cash paid for wages throughout the year is 2875. And it's shown as a debit in the wages payable account to make it balance. But also think about it. Whenever you pay off a liability, you're going to debit the liability and credit cash. And that's why the debit needs to be on this side, not only to make it balance, but because it's logical. So we just came up with another number that we're going to use in our direct method statement of cash flows in the operating activities section. Cash paid to employees for wages. And remember, when cash comes in the door, we should show it as a positive number. When cash goes out the door, we should show it as a negative number. Now let's calculate cash paid for insurance. We look at our accrual basis insurance expense, and we see if there are any balance sheet accounts either in the asset section or the liability section that will affect the insurance expense. And we do have prepaid insurance as an asset, and we do not have any liabilities that relate to insurance. So we need one T account. It's prepaid insurance. The beginning balance is $1,665 debit, and the ending balance is $1,110 debit. You will need the accrual basis insurance expense, and you will need to calculate cash paid for insurance. So here's your T account. Go ahead and calculate cash paid for insurance. And when you finish, start the video again to check your work. Did you calculate 0? That is the correct answer. 1,665 beginning balance. $1,110 ending balance. Accrual basis insurance expense 555 as a credit to this account. For the same reason, throughout the year when we record insurance expense, we debit insurance expense and credit prepaid insurance. And to make that balance then is 0. 1,665 minus 555 equals a 0 debit to calculate the correct $1,110 ending balance. Another way of looking at this is that last year we paid $1,665 cash in advance for insurance. On the accrual basis, we do not include that in 20X1 insurance expense, but include it in prepaid insurance. This year, $555 of the amount that was prepaid expired, but none of that was paid in cash in 20X2 because all of it had been paid in cash in 20X1. Now let's do cash paid for rent. Cash paid for rent would include the change in any balance sheet accounts affecting rent expense. Those accounts could be prepaid rent or rent payable. If you look at the balance sheet, there is no rent payable and the balance in the prepaid rent remains unchanged. Therefore, the amount shown on the accrual basis rent expense is the same as cash paid for rent. But let's prove that by running everything through the T accounts anyway. The beginning balance of prepaid rent was $825, and our ending balance of prepaid rent is $825. The accrual basis rent expense off the income statement was $2,475. What do we need to get it to balance? That is a debit to the account which represents cash paid for rent. So cash paid for insurance was $0, and cash paid for rent was $2,475. Well, let's end this video for now. In the next video, we'll finish the calculations by calculating cash paid for supplies, advertising, mileage, and repairs. We'll answer the remaining 2 questions on this spreadsheet. See you next time.